In this lecture, I will guide you through the complex regulatory environment that shapes digital banking today. And also, digital banking is fundamentally transforming financial services, creating both opportunities and challenges for regulators worldwide. And for example, actually, frankly speaking, I find it essential to examine how regulatory frameworks are evolving to address these changes. And let me walk you through the key aspects of digital banking regulation. Now let me explain the three fundamental aspects of digital banking regulation that you need to understand as future fintech professionals. First, I want to emphasize that regulatory frameworks for digital banking are not uniform. They vary significantly across different jurisdictions and also regions, and they are constantly evolving. And this variation creates unique challenges for international financial institutions also. And secondly, you'll notice that countries are taking different approaches as they try to find the right balance between promoting innovation and maintaining adequate consumer protection and financial stability. And now let me outline three critical policy concerns that regulators must address in digital banking. The first concern I want to emphasize is cybersecurity risks. As we shift more banking services to digital platforms, we're seeing increased vulnerabilities to hacking, phishing attacks, and also online fraud. And this represents a fundamental challenge for both banks and regulators. And the second issue I need to highlight is transparency. For example, digital interfaces, while convenient, can sometimes make it difficult for customers to clearly understand pricing structures and fair information. And this lack of transparency is something regulators are particularly focused on addressing. And finally, I want to bring your attention to what I consider one of the most pressing issues, which is digital inequality. That is, not all segments of society have equal access to reliable internet or possess the digital literacy needed to use these services effectively. And this creates a risk of financial exclusion that regulators must address through appropriate policy measures. And now I would like to walk you through how different major economies are approaching digital banking regulation. For example, you can consider Singapore and the United Arab Emirates, which are jurisdictions that have implemented specialized digital bank charters specifically designed to foster growth in the fintech sector. And in contrast, countries like the UK and Australia have taken a different path by establishing regulatory sandboxes. And these sandboxes provide a controlled environment where fintech companies can test their innovations under regulatory supervision. And for example, when we look at China and India, we see yet another approach, because these nations are focusing on state-led initiatives to develop digital infrastructure and set industry standards. And each of these models reflects different priorities and market conditions. For instance, the sandbox approach demonstrates a commitment to controlled innovation, while specialized licenses show a more direct strategy to attract digital banks. And understanding these different regulatory models is essential because they shape how digital banking services can operate and expand in this market. Well, now let me explain why the European Union's PSD2 framework represents a significant development in digital banking regulation. At its core, PSD2 aims to create a harmonized financial services market across the European Union. And what makes this framework particularly interesting is its passporting mechanism, because when a provider registers in one European Union member state, they can operate across the entire European Union market. And I want you to understand how this differs from other regulatory approaches, particularly when we compare it to the United States. And in the US, we see a more fragmented regulatory landscape, while vary requirements across different states. And this contrast between the European Union's unified approach and the US fragmented system, which highlights different philosophical approaches to digital banking regulation. And European Union model demonstrates also how regulatory harmonization can potentially reduce barriers to entry and promote competition in digital banking services while still maintaining robust oversight. And now let me clarify what I think is one of the most crucial points about the US digital banking regulatory landscape, which is the division between state and federal oversight. And this creates a complex regulatory environment that's fundamentally different from what we see in other major markets. For example, I often emphasize that this dual system means digital banks must navigate multiple layers of compliance. And for example, the state-by-state variation in regulations creates unique challenges for digital banks trying to operate nationwide. And I will illustrate this with a specific example. For example, a digital bank might need to obtain separate licenses in each state where it wants to operate, unlike the European Union, where a single license can cover multiple countries. And this fragmented approach has significant implications for how digital banks structure their operations and expansion strategies in the US market. And I would like to help you understand also China's unique approach to digital banking regulation. For example, what distinguishes China's strategies is the government's active role in promoting partnerships between state banks and private technology firms. And for example, I think this is particularly interesting because the state explicitly directs banks to collaborate with technology leaders, creating a controlled environment for innovation. And let me give you a concrete example of how this works in practice. For example, you can consider the emergence of services like WeBank or WeChat Pay. And these aren't just commercial ventures. So they are the direct result of the state-guided collaboration between banking and technology sectors. And this approach reflects China's broader strategy of maintaining strong state oversight while fostering digital innovation. And for example, when I analyze this model with my students, I also emphasize how it differs from the more market-driven approaches we see in Western economies. And here I would like to examine how India is taking a structured approach to digital banking regulation, specifically through three key components. First, let me explain their API standards. And India has mandated open access for fintech firms to banking systems, which I consider a crucial step in democratizing financial services. And the second component I find particularly noteworthy is their emphasis on real-time payment standards. For example, India has established clear regulatory guidelines requiring immediate transaction capabilities, which has transformed how payments are processed. And finally, I must highlight that United or Unified Payments Interface and this regulatory framework has effectively spurred private sector innovation in digital payments. And what makes India's approach particularly interesting is how these three elements work together. For example, the API standards provide access, real-time payment requirements ensure efficiency, and the UPI framework creates a standardized platform for innovation. And this coordinated regulatory approach has helped India develop one of the world's most advanced digital payment ecosystems. And now I want to help you understand the distinctive regulatory approach that Singapore and the United Arab Emirates have taken to attract digital banks. And for example, what sets these jurisdictions apart is their virtual incorporation framework, because they allow non-resident companies to establish digital banks without requiring a physical presence. Let me explain why this matters. This regulatory flexibility has successfully attracted major global fintech players to establish digital banking operations in these markets. And I find it particularly significant that both countries have strategically positioned their digital banking regulations to target underserved segments, especially small medium equities, entities, and institutional clients. And for example, when I analyze these frameworks with my students, I emphasize how this regulatory approach demonstrates a clear understanding of marketing gaps and also strategic priorities. And hereby, I want to share some significant market dynamics between traditional and digital banks. For example, we are observing a clear trend where traditional banks still maintain market dominance, but digital challengers are gaining ground rapidly. The data indicates that digital banks are projected to double their market share by the end of 2025, and this shift reflects change in consumer preferences and technological adoption. And for example, when I analyze this trend with my students, I emphasize that this isn't just about market share, it represents a fundamental transformation in how banking services are delivered. And now let me explain the complex dynamics of open banking regulation and data portability. And at its core, open banking regulations aim to expand consumer choice and foster innovation in financial services. Now, for example, when I teach this concept, I always emphasize that while these regulations require banks to share customer data with, say, third parties, these create significant privacy and security considerations. For example, privacy advocates raise valid concerns about potential data misuse and security vulnerabilities also. And I find it particularly important to note that this regulatory requirement for data sharing creates a delicate balance, and we must weigh the benefits of increased competition and innovation against the risk of data breaches and also privacy violations. And now let me walk you through three critical aspects of stablecoin regulation that demonstrate the complexity of regulated digital assets. And first, I want to discuss regulatory hurdles using a concrete example, the Diem project. Its challenges revealed significant gaps in our current crypto regulatory framework. And this case study illustrates why we need comprehensive regulation for digital assets. For example, moving to the international perspective, I find it crucial to emphasize that we need a coherent, fragmented approach we currently have, which creates regulatory arbitrage opportunities and risks. And looking toward future developments, I need to stress that appropriate regulatory frameworks are essential for tokenized money to function effectively in our financial system. And now let me explain how international organizations provide guidance for digital banking regulation. And at the global level, we have three institutions shaping the regulatory landscape. The Basel Committee plays a fundamental role by establishing principles for managing banking risks and promoting innovation. And their recommendations serve as a foundation for international and national regulators when developing their frameworks. And the Financial Stability Board focuses on fostering cooperation between different jurisdictions and provide guidance on managing systemic risks in digital banking. And IOSCO which is the International Organization of Securities Commissions, works on harmonizing securities regulations across borders. And this is particularly important as digital banking often involves cross-border transactions and new financial instruments as well. And I want to highlight how regulatory authorities are working together across borders to harmonize digital banking oversight. And from my work with regulatory bodies, I've seen a clear trend toward bilateral partnerships between financial authorities of different countries. And a prime example of the Digital Operational Resilience Framework, for example, which represents a significant step in creating regional standards. And this framework demonstrates how countries can align their approaches to digital banking regulation while respecting the individual market characteristics. But however, we still face substantial challenges in key areas. For example, data access remains a complex issue. There is different jurisdictions have varying approaches to data privacy and sharing as well, and cybersecurity protocols also need better alignment and so on. And moving beyond government regulations, I'd like to discuss how the private sector continues to digitally continues to contribute to digital banking governance. And in my research and consulting work, for example, I've observed that industry self-regulation often complements official requirements effectively. And for example, the private sector has developed its own set of principles for responsible digital banking as well. And that is why leading financial institutions have established voluntary standards that go beyond minimum regulatory requirements. And this includes enhanced customer authentication protocols, for example, transparent fee structures, and also robust data protection measures. And for example, I have worked with several digital banks that implemented their own governance frameworks. And for example, one particularly effective approach I've seen involves regular third-party security audits and customer feedback integration into service development. And this proactive stance helps build trust and often uniforms future regulatory developments. And now let me explain how international banking norms are shaping the digital landscape. And for example, my experience in traditional banking regulation provides valuable context here. For example, traditional banking has established clear precedents for regulatory convergence. You can think of the Basel Accords and their global adoption. And these historical partners offer insights into how digital banking regulations might evolve. And in the current emerging landscape, we are witnessing the gradual development of coherent international principles for digital banking. For example, drawing from my work with central banks, I can tell you that regulators are actively seeking ways to harmonize their approaches while respecting local market conditions. And also, the development of global standards is inherently complex and requires careful alignment of different regulatory philosophies. And now let me address the core principle that shape responsible digital banking policies. For example, drawing from my regulatory advisor experience, I emphasize that effective policies must balance multiple critical objectives. And first, we must consider financial inclusion alongside consumer welfare. And this means ensuring digital banking services are accessible to all segments of society while protecting consumers from potential risks. And for example, when I worked with regulators in emerging markets, we developed frameworks that require digital banks to maintain certain accessibility standards while implementing strong consumer protection measures. And second, system stability and market integrity remain paramount. Because based on my experience overseeing digital banking transformations, I've learned that maintaining financial system stability requires sophisticated monitoring systems and also clear intervention protocols. And third, the key to success lies in adaptive policies. For example, I've observed that the most effective regulatory frameworks are those that can evolve with technological advancement while maintaining core protective principles. For example, you can consider how regulators adjusted their frameworks when open banking emerged, and they maintained security standards while enabling innovation. Well, now let's summarize the essential points we've covered about digital banking regulation. And first, we see significant regulatory fragmentation across jurisdictions. Now, for example, I've observed how these variations create both challenges and opportunities. And for example, each jurisdiction takes its own approach, reflecting local market conditions and policy priorities. And mobile technology adoption is fundamentally changing banking behavior. And for example, as more consumers rely on mobile banking, regulators must adapt their oversight approaches. And policy models vary significantly between jurisdictions also, because some regulators, like those in the UK, prefer innovation offices and sandboxes, and others, such as in China and India, focus on developing public infrastructure and so on. And for example, Singapore and United Arab Emirates have become particularly interesting cases because their digital banking licenses have successfully attracted major global tech players, and that is interesting. And finally, open banking initiatives raise important concerns about data privacy and security. And in my regulatory advisory work, I've helped develop frameworks that balance innovation with robust data protection measures.